British businessman Jim Ratcliffe is another name in the early mix. Manchester United fans have called for a change in ownership because of the team's disappointing performance in recent years. And China has made a rare public comment on why it's failed to show Hollywood blockbusters such as the Top Gun sequel. A senior official says American filmmakers should show more cultural respect. Top Gun Maverick was seen as celebrating the US military, and Tom Cruise's character wore a jacket that displayed Taiwan's flag. Other films blocked recently include Disney's Doctor Strange in the Multiverse of Madness and Eternals. And that is your latest Business Flash, Alex.
I feel like missing Eternals, though, was probably okay. All right, let's go to Kohl's for a second. The shares are falling today after it slashed its full-year outlook, also dealing with margin pressures as well as weakening demand. So it says that customers have been continued hurt by inflation. The question is, how much longer will it last? Joining us now for more is Daniela Sartori Cortina, who covers consumer goods for Bloomberg. With Kohl's, though, I think it gets particularly interesting because what part of this is the macro environment, right? We know that margins are under pressure. We know that consumers are stretched versus what's Kohl's specific at this point?
That's a really good question. And, if you ask Kohl's, they will basically pin it on the macroeconomic environment. On the top line, they said that middle income consumers are being really pressured, coming less into stores, spending less, and getting more, seeking more value products. For example, they said that for women's apparel, women are looking for more basics over fashion items, things that you can rewear. And then you, of course, have, the margin pressures, as you were alluding to, in terms of freight, in terms of, cost, and in terms of increased promotions. The question is, does everyone believe that? And, today, at least one analyst suggested that's not the case. He pinned these woes on internal issues at Kohl's, including perhaps not getting the merchandising right.
Okay. Are they just in the wrong place in the market? The high end looks all right. Low end generally actually much more resistant in terms of tougher environments. People still continue to have to shop in that space. They're just in the middle. That's got to be the worst place to be right now.
That's what seems to be the case. And they did say that they are seeing more high-income consumers come into their stores buying more. At the same time, they're emphasizing that they want to be, as you said, sort of in the right place with the right offering for consumers as they suffer because of inflation. And interestingly, they did say today that their private brands, so their proprietary brands, actually saw more growth than national brands for the second straight quarter.
So wrapping it up then with Kohl's, what are they supposed to do now? Like, what are their options that are on the table?
Right. So, one of the things that they've really emphasized is the partnership with Sephora. They keep betting on that. They opened, 400 stores in 2022. And they said that since, they started that partnership last year, there are 1 million new customers. So really, that's what they're betting on right now. And we didn't really get an update on any other, strategic reviews, like, for example, the sales that had been talked about earlier in the year.
It's going to be interesting what discounting looks like in the second half, as you say. Daniela, thank you very much indeed.
Anytime.
Alex, that's her favorite subject. Daniela Sartori Cortina, thank you very much indeed. Alex, we need to talk more about retail. We've had a lot of data this week. We've had a lot of corporate reporting this week. We're going to stick with that theme. July saw a better than expected outlook for the sector on this week's data. We're going to break it down. We're going to go into the macro story a little bit more. Elizabeth Erbert, Infosys Consulting CIO Advisory Partner for Retail, is going to be joining us next. This is Bloomberg.
about an hour into the U.S. trading session. Volume super light. I feel like this is my theme of the entire week. Bloomberg's Abigail Doolittle is tracking those moves. Abigail?
Well, it does certainly feel like and look like a summer Thursday, not a Friday, but a summer Thursday on those light volumes, tiny moves. We're looking at another down day, but let's see whether or not it reverses. The S&P 500 and the NASDAQ both down fractionally at this point, where we have a much bigger decline. Bed Bath & Beyond down 27%. This, of course, on the news that Ryan Cohen of RC Ventures filed that to sell a stake of about $9.45 million. He's the biggest, his firm is the second largest shareholder in Bed Bath & Beyond, to sell that stake. Now, he's got a tricky job because, as you can see, the stock is down 28%. So the goal would be to sell it with the full profit. So how do you leak it out with taking out the price? Again, a tricky job for a very good trader. Crude oil up 2.4%. So perhaps we have this one risk-on asset here. Maybe it'll lead into stocks. One reason, though, to think that stocks could continue to decline, valuation is creeping higher. These are the forward PE on the NASDAQ, and you can see that it is back above the historical average, right around 20 times forward PE, creeping closer to 25. So the rally has been good for stock investors, tech stock investors, but it hasn't been so great for valuation, making these stocks look a little bit less compelling, particularly if interest rates do continue to rise. Not rising existing home sales. You can see this is the trend this year going in the wrong direction. For the month of July, 4.8 million existing homes were sold here in the U.S. So you have this tight supply issue, but you may also have a little bit of a demand issue at this point. At this point now down 25%. And then finally, if we take a look at more declines, a bit of a bearish day here. Retail Kohl's down 6.2%. They put up a really rough quarter. They missed, they slashed. Next year, margins have been slashed, those rising inventories, thinking about maybe monetizing real estate to give an idea of what they're thinking about in terms of producing cash flow. Macy's and Nordstrom, the other department stores that report next week, down in sympathy. So it's been an interesting quarter for these retailers, Guy, for sure.
Yeah. Abigail, thanks very much indeed. Interesting is maybe one way of describing it. Abigail Doolittle on what's happening in the markets. So we've just been talking about it. Better than expected earnings from large US retailers are putting a positive spin on stocks. We're talking about in aggregate over the week. Interesting is one way of describing it. I think there's been some clear differences and some big gaps. Cost pressures, low margins remain challenging. Is the consumer going to keep going? And which type of consumer is going to be keeping going? Elizabeth Eberts, Infosys Consulting CIO Advisory Partner for Retail, joining us now. We're coming into the end of the week, Elizabeth. Most of the major retailers have reported. We've had retail sales. What is your takeaway from what we've learned?
Yeah, my guess is that under the covers, the companies that are reporting better results are the ones that have been able to manage the inventory glut a little bit better. I was a little bit surprised to see the differentiation between the Walmart and the Target performance, but my guess is that underneath, Walmart managed to be a little bit more aggressive in terms of managing their inventory forecast. They're tremendous at managing their supplier network, so it seems that might be one of the reasons why we see such profound differences in the performance of those two organizations. They're all in the same boat, maybe Home Depot a little bit less. I'm not sure they're as much of a participant in the holiday season, but the big box stores and the specialty retailers are all preparing for the holiday season. So the criticality of the movement of this inventory out of warehouses is becoming more and more important just because the holiday products are coming into the stores virtually as we speak.
Well, also then it relies on getting demand right. And that's where I've been very confused over the last couple weeks. And I think Jefferies had a note out yesterday, and they really summarized that for me, so I wanted to read it to you. It said, while the consumer sentiment is now firmly in recession territory, consumers are not following through on their feelings. They're spending based on their finances, which are still very healthy. Do you think that difference is going to continue? And if you're a retailer, how do you look at that and say, oh, I know exactly what to do for the next 6 months?
It's super, super hard. I think we had a little bit of an improvement in consumer sentiment, but you're right. Really, for at least the last year, there's been a real difference between how we feel as consumers and what we do as consumers. And, I think the secret is going to be for retailers just to be much more responsive to the data that they're getting, to be able to sense the consumer changes and respond. So having that sort of data collection and being able to sort of turn on a dime is going to be really important. The other thing, we've talked about supply chain for a couple of years, I think, at this point. There's a fundamental change in how retailers are optimizing their supply chain to give them a little bit more flexibility and agility. Over the past 10 years, maybe even more, it has all been low-cost supply chain. Now we know where low cost has gotten us, and we need to start thinking agility and being able to respond to a change in consumer demand. And that's going to happen until we have a couple of quarters of consumer behavior that can be taken into account with the retailers and all of their planning mechanisms. We have seen some interesting data on back to school, where the back to school buying behavior curves are lining up with the traditional ones. So we're seeing some normalization there. But between the recession and COVID and supply chain challenges, the rest of the consumer data hasn't really settled down yet.
Elizabeth, let's say gas prices go back up to, say, circa $4.50. How does that change the picture?
Well, I think the thing with gas prices is everybody gets in their car or, on the bus or whatever, and you see those prices, and that changes sentiment pretty aggressively, right? I mean, you're just reminded block after block after block when you see those numbers going up. So a lot of the, recessionary fears can be, really self-inflicted at some point. So we get a little bit of a boost when we see those numbers going down. I think the sentiment then is more positive and firms up. But it's just very much dependent sort of on how those winds blow and how the consumer responds. It's always interesting when there's, stories about how the consumer feels that they're spending, double what they have in terms of grocery, and then you look at the data and maybe it's up, 20%, which, is still a lot, but, it's very hard to align how how consumers feel about the items they're buying and the prices they're paying. Nobody's really comparing those receipts at the kitchen table. But everybody knows it feels bad.
Where do we stand on consumer credit? And when do you get worried and tell retailers guys, we're going to run into a problem with people being able to buy stuff?
Yeah, sometimes it's not that big an issue to the retailer. It's more of a, banking issue. Most retailers may benefit from some sort of branded relationship that they have with a credit card. Many specialty retailers have exactly that. So they don't necessarily worry at these earlier stages. More of a banking and financial services issue. I think the concern is when there's a big tap out and the credit situation is more of a credit crunch. Right now, I think we're at the earlier stage of that curve, so it's just something to monitor and once again collect data on so that retailers understand where the consumer's head's at.
Elizabeth, what do you think is going to be big this Christmas? What trend should we be looking at? Trying to understand the consumer at the moment is very difficult, but even at this early stage, is it possible to get an idea?
Oh, it's awfully hard to know. It'd be a tough job these days to have a merchandise planning job at a retailer. I think I'm reflecting back on, coming off of this travel season. I think we're still catching up on experiences. And that's not going to benefit retailers quite as much. It's going to, be really the push continuing on, and then all the challenges we see in the execution with the airlines and the pricing on hotels. We are seeing a little bit of a replenishment cycle, though. So people who are, sort of emerging from home and coming out of quarantine. When we see the back to office initiatives, it makes me think that there's going to be some improvements in terms of apparel. As we go through the whole process of I can't, go back to the office and wear the same, dress or pants or whatever. So we may see some bump then in apparel, I think, for this holiday season.
Elizabeth, thank you so much. Really appreciate the perspective. Elizabeth Ibert, Infosys Consulting CIO Advisory Partner for Retail. Good stuff. All right, coming up, staying with the consumer for a second, another sign the U.S. housing market is cooling off. So we're going to talk about that drop in existing home sales with Mark Zandi, Moody's Analytics Chief Economist. This is Bloomberg.